Thank you very much. And right, we've got about 55 minutes or so, and the mission here is to help you improve the sustainability of your new business in a financial sense by sharing with you some key finance tools. This has been something of a whistle stop, but whistle stop rather. But as we work together, if there's anything you want to ask about the financial aspect of starting a new business, then just feel free to. I'll tell you what would be really helpful to kick us off, if this is okay. So Gemma, I hope I'm not revealing your secret by saying that you do cat breeding as your business. And Jenny and Hayley, I'd just be interested if you could very briefly tell us what it is you do. And the only reason I'm asking this is so that I can make some attempt to relate the sort of things we're going to talk about here on finance to the situation that you are in. So Jenny, if I may ask, what is it you do?
Oh, good morning. So we're a heating and renewables installation company. So renewable technology like heat pumps and energy efficient boilers. We install them, repair them, service them. Yeah, all that kind of stuff, really.
That's great. All right. And Hayley, you're ahead of me. You already put that in the chat. So that's brilliant. Okay, that's fine. Look, I've got some ideas of what to share with you, but just at the start of this, again, so I can make sure that you're getting out of this what you want. Are there any particular questions you've got, or anything in particular you want to make sure we work on in terms of managing the finances of a small business? Anything in particular, you either pop it in the chat if that suits, or just unmute and tell us if there's anything in particular you would like to get out of this little session. Right, let's go. I think you can see my slides, and as Rob will tell you, the slides here are going to give you some idea of what's going on, and you'll get a set if you give us feedback at the end. So you're going to get just about an hour and some thoughts about budgets and cash flow and an opportunity for questions. You're not going to get any guarantees, all right, because there aren't any. And you're definitely not going to get financial security of life for life within the next hour as well. But you will get this. Okay, and when we're okay, and Hayley, actually, your question in there as well, right? What should I record? Right, I'm confident we're going to go there for this as well. And the reason this is it's this tools thing that we're on about is that in this webinar, I'm going to share some tools with you and some ideas. But the thing with any toolkit is actually it's not about the tools that's important. Like any craft skill or anything like that, it's what determines this is the degree and the enthusiasm with which they are used. In other words, it depends on the person using them. So consequently, this workshop is about tools, but it's not about rules. So I'm not going to tell you what you must do. I'm just going to offer you some thoughts and guidance about where you are, given the different businesses that you're in, and what might help you and what might be useful for you. As we work together, when I say get real, that means that I'll try and apply these to the different businesses we've got. It's good we've got a range of different things here as well. But if there's anything you want to ask about your business, you can. I suggest you take notes. You don't have to, that's something up to you, but I suggest you take notes. I still use one of these as a piece of paper, but if you use whatever device works for you, then that will work just as well. And as Rob said, this call is recorded, but you don't have to share anything confidential or anything like that if you don't want to. Right, let's go straight in then. And here is a tool. This can be used in any business for anything. And it's called the 5 levers. And it comes around one particular question about what 5 levers can be pulled to increase profit. Let me just say a word about profit for a start. Is that if you want your business to last, there is one very simple thing that you can do to make sure it lasts and it's sustainable in the future. And that is to make sure you get more money come in than goes out. That means you can sleep at night. It means your business will be there tomorrow and for the future. And if you just do that, then your business will survive. This is what I mean by increased profit. You might want to get even more money coming in than is going out. And you don't have to have gold taps in every yacht, in every port, kind of thing, necessarily. You decide what the amount of things is going to be. But just to keep a business going, you need to have profit. And indeed, any organization, you need to have what I call profit. I was working with a charity last week. They call it surplus, but it's the same thing. It's having more money coming in than going out. There's 5 things you can do, all right, in any business that will help increase profit. Now, I'm just going to quickly tell you what these are, okay? Some of these might be of more use to you than others. You don't have to pull all 5 levers, but I'm going to share the levers with you, and then I'm going to ask you a question. All right, here are the levers. If you want to increase profit in your business, first of all, is you can increase your sales to your existing customers. If you've got an existing customer base, what this is going to mean is Hayley, the people that you coach already might want you to coach them some more. Gemma, if someone has had a cat from you, they might want to. Okay, they don't have to have to, but they might want to. Okay, so you can always increase your sales to existing customers, but that might not be enough, and therefore you might need to get some new customers in, to find some people that you haven't served before and to serve them. When you've done that, another option might be to bring in sales of new products. Now, when we're talking about new products for cat breeding, Gemma, you're going to be way ahead of me on this one. But I'm not talking about necessarily different types of cats or different sorts of animals, but there might be some additional cross sales that you can make, that other cat breeders make, so that their customers get a better experience. There's 2 other things you can do to increase your profits. Firstly, you can increase your margins. In other words, very simply, put your prices up there. And by increasing your margins, that is going to maintain your profitability. And then there's the 5th one. Right, and the 5th lever, you can always cut your costs. So in any business, in any organization, if you want to increase profit, those are the 5 levers. There aren't any other levers. Anything else you do in business, like, you know, advertising or marketing or increasing your capacity, whatever it is going to fit under one of those 5 headings. So here's a question for you. What is the difference between lever number 5 and the first 4 levers? All right, what is the difference between lever number 5 and the first 4 levers? What do you think? Gemma, what do you think is the difference, if I may ask you?
Cutting costs is something that you can budget for. So yeah. Analysing everything. In terms of difference, I'm struggling.
No, that's all right. Now, you make a good point. And listen, we're going to talk about budgets. I'm actually going to suggest that when it comes to budgets, as you'll see, all of these 5 are things that can be budgeted for. And I'll pick that up again in a little bit. Here, they all can. All right. But let me show you what I mean. Is that levers first 4 levers here are all increases. Now, not only are they increases, I'm going to suggest that they are all unlimited. All right, there is no cap on what you can do with your prices, what you can do with products, and which customers you can serve. And if you look at businesses that are successful, and I'm sure you'll be able to think about your own examples, then there will be times when they've been successful by pulling these levers, either increasing what their customers buy from them or getting new customers, new products, and putting the prices up. Lever number 5, though, is different. Lever number 5 is limited in its impact. In that, even if you cut your costs to 0, then that is the most benefit that you would get out of pulling that lever. But here's the thing, you can't run your businesses on 0, because if you're breeding cats, you've got to have somewhere to keep them. You're definitely going to get involved in vets fees and things like this. And Hayley, you're a coach, and when coaching, right, you've got to have somewhere to coach from, and probably a mobile phone and a Wi-Fi connection and things to coach with. Everyone has costs, and you can't run your business on 0. So when looking to increase profit, think about the direction that you want to go in and which lever or levers are going to work best for you. I'll share with you one other thought on this, is that depending on what it is you want to do, pulling lever number 2 or lever number 3 especially will be more difficult if at the same time you are pulling lever number 5. Now, nothing's impossible, but it's pulling especially levers number 2 or 3 usually need some sort of investment. They've got some sort of cost attached to them. So use the levers sensitively and try not to get clashes between them. But the 5 levers is the first financial tool I'll share with you. Okay, that's the first one. Now, we've already talked about what the second one is. Let's go here and talk about budgets. Now, when I'm talking about budgets, I want to just highlight one thing about where budgets come from, is that once you've been in business for a while, then you'll find that you have to declare things to the tax person. And indeed, depending on how your business is going, you might get an accountant to complete a set of accounts for you. This is what's called financial accounting, and what an accountant would do at the end of the year. And that's for someone like the tax person, who is an external stakeholder. When we talk about budgets, though, this is much more about what you do within your own business and how you manage the money. And consequently, that first bullet on the management accounting, anything goes. There's no rules about this, okay? There's no one going to tell you this is how you've got to do this. So, Hayley, you've asked this question about what should you record. Actually, there's no rules about this. There's just some general advice about it. I'm going to pick up on this in a few minutes. Management information as well, in terms of what you use, and we'll talk about budgets, tends to get looked at more often. If you're only looking at your financial position once a year, look, you're going to have a problem, to be honest. You need to be looking at things more frequently than that. I'd suggest at least monthly, because monthly is probably when you want to be paying yourself something, but also monthly is quite probably when a lot of your costs are going to have to be paid as well. And even basic things, say like Wi-Fi or your mobile phone bill and your electricity, a lot of us are going to be paying those things monthly. So you're going to need to be looking at things monthly as well. And this might also include measuring how you're doing in your business alongside some other key measures. And that means you need to have not just a view of what's going on right now, but some future and some forecast about where you want to be as well. So you can map how you're doing against the plan. So this is where a budget comes in. Let me explain my philosophy on a budget and how a budget works. So the context to doing this about a budget is there is no one right or wrong way of doing this. Okay, you can do it in a way that suits you. I'm just going to talk you through a couple of things or a couple of thoughts about budgets that would help you. In terms of these first 2 points, what are budgets and why do we have them? Well, I'm going to give you an analogy shortly, which will help you think about having a financial plan for your business to help you steer it in the direction you want to go. In this plan, there is no how you should do a budget or how you do a budget. As long as you do one, then you've got something that to help guide you. And I'll give you an idea about how you might go about this at a very high level. There's one other question point as well, which illustrates budgets, I think, quite nicely, namely this point on number 5. Now, some of you may have heard, maybe not in your own businesses, but maybe in a different context. And Gemma, you'd also told me what your day job is here as well. And this is an organization that definitely has budgets, but you might at some point have heard the phrase, it's not in the budget. We ask, what does that really mean? Well, if someone tells you that they can't spend something because it's not in the budget, at the moment they say that to you, they are, of course, technically correct, because it's not. But it doesn't mean it can't be. You see, a budget is about the future. So you can put anything you want into any budget at any time. So, Hayley, okay, you might have someone, you just said this is quite commonplace, right? You might have someone who wants to do coaching, but they say, yeah, it's not in the budget. Okay, they can put it in the budget. Right? Your mission, therefore, is to convince them as to why they should, and even maybe coach them through how they can make that happen. But a budget's about the future. You can do this. I could imagine that some of you have done what I have done, even with our own domestic household budgets, and just thought, right, we're going to do this, and actually we're going to spend a bit more than we thought. And you would manage that situation. I'm not talking about wildly spending. Okay, but you can do this. If you don't believe that you can change your budget, then as an example, I just ask you to cast your mind back to just over 3 years now, just from a financial point of view, because just over 3 years was a very painful time for all of us. But in March 2020, Rishi Sunak, the then Chancellor of the Exchequer, got up and presented his annual budget to the Houses of Parliament. Yeah, and I commend this statement to the House. 2 weeks later, he announced another £288 billion of support for British industry, which was called furlough, bounce back loans, CBILS, the hospitality grant scheme, and everything else that went with lockdown. That, just 2 weeks earlier, was not in the budget. Now, just because he does that, doesn't mean you should necessarily, but the whole thing about budgets is it's the future. You can change them and you can amend them. So what is a budget? I think it's this, all right, namely a flight plan. If you get on one of these things at the top corner here, all right, if you get on one of these, actually, I was on one last night because I was working in the Netherlands during the day yesterday, and I caught one of these last night to come home. And what I always do when I get on, I know I'm going to turn right, but I always look left to make sure there's someone at the pointy end who's got a plan, because if they hadn't got a plan, I wouldn't get on it. The plan knows where the starting point is, and it also has got an idea of where you want to be, where you want to get to as well. And depending on the flight and the destination also determines the time scale, right? And you as business owners, you determine your time scales. Here's the first thought when you're doing a budget. It doesn't have to be for 12 months. Now, look, if 12 months suits you, fine. But there's no rule that says a budget has to be for 12 months, especially if you're starting out or you're just working out what you're going to do. 3 months. 3 months is good, right? Much less than 3 months is a little bit short, I think. But, you know, you can absolutely do this as well. 6 months, much more sensible, but you don't have to do anything for 12 if you can't get there. And a budget is a plan of where you want to go, how you're going to get there, and how you're going to handle the inevitable issues that will come up along the way. In other words, some of the issues that are going to come up along the way, you'll already have an idea about. But let me explain something about this flight plan, which is also relevant to your budget. When an aeroplane gets to the point that you can see on the picture here, I hope you can see my slides. When an airplane gets to that point, it is already flying off course. Most aeroplanes spend most of their time flying off course. At the point you see in the picture, it won't be very far off course, only be a little tiny bit. But if the pilot does nothing at that point, the aeroplane won't get to where it needs to be, won't even get to the right continent. And whilst you look up in the sky and you see vapor trails from planes and they look dead straight and things, actually what's going on is that in every moment, the plane's drifting off course and then the pilot or the autopilot is taking action to get it back on course. This is what a budget is for you. This is why it's a tool. It's a tool to help you get to where you want to be. And it's a flight plan. Here's the inevitability. Just like an airplane will always fly off course, the actual figures, when you compare them to your forecasts, will be different. Okay? I could imagine if some of you have worked in other organizations, you might have seen budgets in management meetings or something before. And I always challenge anyone who's ever seen a budget and looked at the actual against the budget. Have you ever seen an actual exactly match the budget figure? And the answer is no, you haven't. In other words, we all know what normal is, that reality will be different from the plan. That's not a problem. That's normal. The issue then is how you use the plan to make a decision so that you still end up where you want to get to. All right. So consequently, this tells us that budget, that the actual will be different, but also that the budget is only going to be useful as a tool if, like a flight plan, you use it throughout the journey and not just at the airport. All right. So that's some high-level stuff about a budget. And using a budget, using a flight plan, is what's going to be the difference between whether you are pilot or passenger in your business. Yeah. If you're using the plan, making adjustments, you're the pilot. If you had a plan and you haven't looked at it, you're passenger. Okay. And if you're passenger, you might get to where you want to be. But if you're the pilot, you're the one that makes sure you get to where you want to be. And that's the difference. How do you go about budgeting? There's a couple of words here which come around budgeting, which might help. There's two main styles of budgeting. What's called incremental budgeting is where if you've already in business and you've already know what the costs are, maybe you're committed to some, premises costs and things like that. You've got some existing costs. Then you do what's called incremental budgeting. In other words, you map those costs and then you project what they're going to be into the next year. And you do an increment. Zero-based budgeting is different. Zero-based budgeting could be what you're going to do if you are just starting out. In other words, you haven't got anything at the moment. You don't know where you're going. And you're starting from point zero. The idea with zero-based is that you don't put in any expenditure unless you can absolutely not avoid it. Okay, so those are the two main types of budgeting as well. There's also this question about top-down or bottom-up. Let me explain what this means for you as new businesses. First of all, with top-down or bottom-up, it doesn't matter which approach you use. You can do either, but let me explain what I mean. When we start with top-down budgeting, your starting point is what you think you are going to sell. Yeah, what you think you're going to sell. In other words, what revenue you're going to generate. Okay, and that's going to be the starting point. So, yeah, if you're breeding cats, how many cats do you think you might get? How much each cat, and so forth as well, plus any extras. Okay, as it might be as well. If you're a coach, how much coaching you're going to do for how many clients at what rate? Yeah. And that's what we call top down, is you start off with where you think you're going to go in terms of revenue. Where you go from there is then you look at what your costs are. Okay, look at what your costs are and then deduct the costs from the budgeted revenue, and that's going to give you some kind of profit, or it should give you some kind of profit. Remember, that's the idea. That's what's going to help. But that doesn't have to be the way you do it. You can also do a bottom up. If you look at where you are at the moment, what costs you have, what are the essential bills you've got to pay from your business? And indeed, depending on what you're producing, what's going to be the costs of doing things in your business? Hayley, as a coach, you're going to have costs, as I say, things like electricity, Wi-Fi, phones, and I do bits of coaching myself. And I'll tell you another of the costs I have, Hayley, as well, in terms of recording this, is coffee. Specifically, actually, on occasions, coffee with Rob Harrison. If I'm having coffee with Rob, when I'm having coffee with Rob, it's not an if. When I'm having coffee with Rob, okay, I keep the receipt. Okay, that is a business expense. If I'm having a coffee with Rob, it's because we're talking about business and opportunities we pursue together. How did we get to work together on BIPCs? Could we have coffee together? But someone has to buy that. And so I've got my receipt from the Warwick Street Kitchen in Leamington Spa, which is often where we go. Okay, and that receipt for the coffee for me and Rob, that's what, it's about £6, right? But that includes the VAT, because right, we're both VAT registered. Okay, we do that, and we hold on to that receipt. And so we've got an idea for cost. So even things like how many times do you meet for coffee and stuff like that. Travel expenses as well, Hayley. All right, absolutely. You've got to keep those. I say yesterday I happened to be working overseas. I've got plane and car hire. I've got all the receipts for those things which I've had to do, and I budget for those things and plan those things. Right. You can plan all your costs, and then when you know what you think all your costs would be, then work out what do you need to sell so that you're going to cover those costs and deliver the profit you want. Yeah. Now look, if you want to do the real bottom up thing, here's another idea. Start off with how much profit you want to make. Yeah. You don't have to do everything and then see if you make a profit. You can do it by design. Start off with how much profit you want to make. Add to that, yeah, the amount of costs that you think you're going to incur, and then your profit plus your costs is got to be the revenue you've got to generate. And that's what I call a bottom up, yeah, because you start with a profit at the bottom and then go up. Whichever way you do, then up to you. When to be VAT registered? Right, quick one. Let's just dive in there, Hayley. If you're at 50k, you don't have to be VAT registered, it's a choice, but you do if you're at 85k, all right, and it's not a choice. My suggestion there, by the way, suggestion as opposed to advice, just so we're clear on this, my suggestion would be there is if you think at a level of 50k that it's possible that you're going to get to 85k, I'd start getting VAT registered, because bluntly, it's just easier to do that before you hit the threshold than go back afterwards. Let me tell you one other thing about being VAT registered, though, as well, which I know from my business, and Rob knows the same as well. You know that cup of coffee that I bought Rob in Warwick Street Kitchen? Yeah, there's some VAT in that, and that VAT, whilst I charge VAT on what I charge my clients when I'm running training programs, that VAT on that cup of coffee gets offset. So when you're doing your business expenses, all the VAT you've got, which might be for your phone bills and everything like that, and the various bits of stationery and bits and pieces, you can claim all of that back as well. And the savings and costs, I can only say it depends here, Hayley, and there is an it depends, because it depends on what level of turnover that you're already at. I can see about the 50k thing there as well, but it depends also how much you're spending in your business to see if you can make it worthwhile. If you book in with a business advisor will be able to help you talk through that particular one. All right, hope that helps. Right, let's do some more work on budgets. As I said, so that's the top down, bottom up. It doesn't matter how you do it, you can do it. By the way, it doesn't matter necessarily how you go about doing your budgets. I know some people that just use like a notepad, all right, and a pen. Fine. Excel spreadsheets are the most common tool. All right, that's what most people do. That's fine if that's your thing, whatever. But remember why you're doing a spreadsheet. You're not doing a spreadsheet or a budget because you think you've got to do a budget. You're doing it because it's a tool that's going to help you get to where you want to be. With that in mind, let me show you an example of a budget here. And this one is the slide is difficult to read. You haven't got to look at all the details of it because I'm going to use this example to show you the tool that you need to have financially to keep you afloat. All right. This is a budget. Let me explain how it works. This is a budget for a small manufacturing business. It's not representative of exactly what you're doing, but it's just an example budget. You'll notice it happens to be for 6 months because, as I said earlier on, 6 months is fine, right? 6 months is fine. At the top, right, they've planned their revenue, what they're going to sell. And let's say this is a small manufacturing business. Included in that, this company employs some salespeople, so they're paying them $35,000 a month. And they've got a production budget, so they've got a manufacturing base for making things. They're planning to buy a new machine in April, and they've put aside some money for some advertising and also some training. I think putting money aside to spend on training is a great thing, not least because I sell people training courses. So there's an example of a budget. There's two things, right? Two things, maybe more than this, but there's 2 points I'm going to draw out of using this example, which are two tools, one of which is absolutely the one that's going to save your life. Okay, but let me show you what you can do with this. First of all, you've got a plan here, so you know what the costs are each month, and therefore what you should got to be selling each month. Okay. Also, here's the first thing. There's another tool coming up from this. Is you'll see there's a totals column down the end, right down the right hand side. We've got a totals column. Hopefully you can see that on the screen I'm sharing with you. When you look at the totals there, what this means is that you can forecast, right, your profit and loss account. In other words, you can do a forecast of what the end of your year will look like. You don't have to wait for an accountant or for the end of the year to do your tax return or anything to see whether you've had a good year or not. You can decide in advance. This forecast of what's called the profit and loss account or your income statement is derived from the budget which I've just prepared. Okay, it's derived from that. And you'll see it's got the total for the revenue at the top. The cost of sales is the production budget I mentioned, and then the other items are the overheads. What you'd notice in here as well is that in this particular example, they are planning to spend a lot of money, £80,000 on a new piece of machinery. Yeah. Now, if you spend a lot of money on machinery, you might not be spending £80,000. You don't have to, but there might be some parts of this where if you're spending money on something which you're going to use in your business over the long term, it's going to be there for years in the future, and therefore you depreciate it. All right. So consequently, that sort of thing is more of an investment. You've got to find the money for it. Okay. But it's not a business expense, but the depreciation is a business expense. Now, this also can have an effect on where you're going with your income. Or okay. Haley, in response to your question there about why are they in different columns, I'm not quite sure what you mean there, but exactly, you know, is that the budget in terms of the nature of the columns, what we've got is we've got a column for each month, okay, here, and then a line for each cost. All right, that's I think the most popular way of laying out a budget. It can be done in any way any way that you want to. But in the forecast, all right, they're in different columns here because what we've done is I've used the middle column. Okay, this is just the overheads so that we can get a subtotal for the overheads in the right-hand column. And the right-hand column then we can see is how we've derived the profit. If it's all in one column, sometimes these things are, if it's all in one column, it's just slightly more difficult to read how these things are arrived at. But essentially in the right-hand column, sales less the cost of sales, the production budget gives you gross profit. And then I've used the left-hand column to total up the overheads. Right, and that's the only reason I've used columns there. If you've got a forecast profit and loss account, this means that you as business owners can then ask yourself some other questions, especially if there's a profit at the end. It means you can do at least two things, possibly three with this. It means you can then start forecasting. Yeah. If you forecast you're going to make a profit, first of all, are there going to be any finance costs involved? Because if you're borrowing money at any time, and in 2023, if you're borrowing money, that will cost you because interest rates are rising. If you've got any finance costs, you build those in. But they would go below this line of what we call operating profit. Operating profit is the profit you make out of doing what you do. Finance costs you put separately. And then if there are any finance costs, you take those off. You can then start calculating what the tax bill is going to be. Because you're going to have to pay, if you're making a profit, you're going to have to pay tax, but plan it. All right, plan it. It's not too difficult to plan for either. If you think you're going to make a profit, then, just take 20% of that off. Okay, and you should cover, if you're a startup, or a small business, 20% should cover most of that. All right, so plan for the tax. And if you're forecasting a profit and you've planned for any finance costs and any tax, then you can plan what you might do with that profit. And it might be you can draw some of it out and use it in the business or use it for yourself, whatever you want to do, but you can plan how you're going to derive your income from the business. All right. So you don't have to wait to see how it goes. Plan it in advance. Now, when we talk about planning in advance, this brings me on to the tool. And if you do nothing as a result of this webinar, just do this one thing. This could be the thing that keeps your business afloat. I'm going to illustrate how this works. I'm going to use this budget example, but I'm going to do something in particular with it so that we get the next tool, because there's one element in this example that makes a crucial difference. It is not how much you sell in each month that is important. It is when that money arrives in your bank account. In this example, this company is selling 123,600 in January, but they're selling that on an invoice. All right, they're sending the goods out, they're sending an invoice, and the invoice gets paid 30 days later. Now, things might be different for you in your business. It's up to you how you go. I certainly know coaches that work on that sort of principle, but I also know coaches who also ask their clients to pay in advance. So it depends how you're working this. But think about the timing of when that money is going to come in, because the timing is what enables you to do a cash flow forecast. Now, this is not rocket science. Indeed, some of you might be doing this anyway, just in terms of managing your own domestic expenditure. It's looking at how much money you've got each month, but you can forecast how much money is going to be in your bank account in, say, 6 months' time. Not just at the end of this month, but how much is going to be in your bank account in 6 months' time, and indeed 5, 4, 3, 2, 1 month's time. The way it works, as you see on this example, is that you, and this is, I've labeled this January to February, but you could start your cash flow forecast easily from the 1st of June if you wanted to. Just go back to the 1st of June and work it out. But this example has got January on it. You look at what is the opening balance on the 1st of January, all right? In the example I'm sharing with you, it's minus 6,000. In other words, they're overdrawn. They're going to get in revenue in January of 68,000. That's because for this company, remember, they're selling on invoice. So whilst their budget is 123,000, they actually sold 68,000 in December. That's what will arrive in the bank account. All right. Okay. They've then got their costs. This business, they've got more costs than I have because they're making stuff. They've got a small factory. So they've got their production costs and their sales costs, the advertising and the training. So they know what the total costs are going to go out of the bank account that month are. What you then do, you take the opening balance, add in the money that's going to be in the bank account, come into the bank account that month, and take off the money that would go out of the bank account that month. And that gives you the closing balance. In this example, it's more overdrawn. It's minus 31. If it's minus 31 at the end of January, it means it's going to be minus 31 at the start of February. Okay. And then you repeat the process. Now, for this business, if they're selling 123,600 in January, that's what should come in February. Okay, they've got their costs out again. They know not just how much it's going to cost, but when it's going to go out. And then by the end of February, they're still going to be overdrawn, but by nothing like as much as they were. The overdraft should be considerably reduced. And indeed, if you look at the rest of the pattern of the cash flow, you repeat the process in March and they're back in the black. But in April, they're buying that new machine, which means they're going to be overdrawn again as they are in May. But by the end of June, it's all paid back. In other words, there's a plan. They can see how they're going to get through. What this company would most likely do with this cash flow forecast, bearing in mind they've got some minus figures at the end of the month, the most likely thing this company would do would probably be to arrange a bank overdraft to cover those peaks of borrowing. And if they're arranging for a bank overdraft, how do you decide how much it is and how it's going to be repaid? Well, the cash flow forecast is the tool that helps you understand that. Of all the key financial tools that we talked about, 5 levers, okay, and having a budget, okay, the key financial tool is the cash flow forecast. That's the one that makes the difference. And let me demonstrate why that is the case. I've got this cash flow forecast on a slide, but I'm just going to switch screen now because whilst I've got it on a slide, I'm going to also show you how this works out on an Excel spreadsheet. So I've got the Excel spreadsheet for the example that was on the slide. Okay, so it's the exactly the same one here. In terms of how this works, the numbers are the same. So as you can see, they've got a revenue of 68,000 in January, revenue of 123,600 in February, but they're overdrawn at the start of January, but it gradually gets repaid. Okay, there's some, lumps and bumps along the way, and there probably will be lumps and bumps along the way. If you know there's lumps and bumps along the way, this is why you use this tool. So you can see not only how big the bump is, but when you're going to experience it. And then you can take decisions about what you do. But here's the thing. This is a small manufacturing business. Okay, I mean, they're successful. And as we've seen from the forecast, they're a profitable business, which is great. So let's just use a bit of imagination here. Imagine you are running this business and imagine it's the 2nd of January. You come into work. One of the things we've already said is that reality will be different from the plan. So you come into work on the 2nd of January and you've got an email and it says, Happy New Year. Hope you had a good Christmas. Isn't the weather awful? And by the way, we are now going to pay you in 60 days instead of 30 days. Lots of love, your customers. Here's the thing. If this business, because you imagine you're managing this, if you're now going to get paid in 60 days instead of 30, that means in January, you're going to get no revenue in. It means in February, you're going to get in 68,000 because that's what you sold in December, 60 days ago. And in March, you'll still get 123,600 in, but that's what you're selling in January. Okay? So that's changed the revenue. But look at what it's done to the bank account. And in particular, it's done to the closing balances. And just that one change in this example means they are pretty much 6 figures overdrawn the whole time. Now, once upon a time, I used to work in a bank. I used to lend businesses money. And I can tell you, I'd look at this and I'm not sure I would want to lend them that much because that is a massive overdraft compared to the rest of the business. But here's the thing. If this business cannot get additional finance, it can't even make the end of January. It hasn't got enough money to pay the wages, pay the suppliers, let alone do the advertising or the training. Okay, so there is there, okay, a massive potential problem. All right. Now, Jenny, Jenny, I think you've asked a really, really good question. How can you forecast if you don't know what your sales will be for any given month? Right? A really important question, this. Okay. And you've got a very amount of work. All right. Should you use historic sales as an example? Firstly, if you want to use historic sales as an example, you can. But let me tell you something about forecasts. No one knows what their sales are going to be in any given month. Right? Whatever is the business, if you're talking about Apple or Tesco, or look, you look in the chat or something, you give me a name of any successful business. No one knows exactly what their sales are going to be in any given month. But the fact that they don't know does not stop them putting a forecast in of what they think they can achieve. All right. And this is one of the reasons you have a budget and indeed have a cash flow forecast. What you're going to put on your cash flow forecast is you don't know what's going to come in, but you make a plan and decide what you've got to achieve. Now, this, when you're having a plan, then brings on some other things. Is that if you just forecast, well, I'm going to have £1 billion in each month. Yeah. But if you do nothing to do that, then you won't get 1 billion. Yeah. But what your forecast is your forecast is just a decision of what you think you can achieve, right? What you think you can achieve. All right. So, Jenny, if you don't know, you are the same as any other business person. All right. Okay. Any other business person. But you can make a decision of what you want to achieve and then look at the actions that you're going to have to take so that that plan becomes reality. All right. And I just also reiterate the point I made earlier on. There's no such thing as reality matching the plan. It will be different. Well, just get used to that. Yeah. Accept it will be different and accept you're then going to have to make some other decisions along the way. Yeah. But the reason you have a plan and what will keep your business alive is if you've got even a forecast of what will be in your bank account in 6 months' time, that's the sort of information that gives you the confidence to go ahead, make decisions and grow a business. Yeah. And also, if you've got a forecast that says you haven't got enough money in the bank account in 6 months' time, then you got the opportunity to do something about it and not wait for the money to run out before you go, oh no, we're sunk. Because this business, right, if it doesn't take action, okay, could well be out of business because it runs out of cash. You don't have to do that. You can make a plan. You can decide what level of revenue you want to get and you can manage it. And your budgets and your cash flow are the main tools. You don't have to, by the way, do a budget and a cash flow if you don't want to. If you want the simple way of doing it, just do the cash flow. All right. But when doing the cash flow, decide not only how much is going to come in, but look at when exactly that's going to come into the bank account and manage that way. That is your key financial tool.